Well, we're joined by the Chief Investment Officer for Octopus Investments, Lothar Mentel. Thank you so much for coming in to speak to us. So tell me more about your expectations for US banks this earnings season.
I don't think, as we've just said, that US banks will be the big positive surprising companies this quarter. But manufacturing and generally industry overall are probably going to do a lot better than was feared just a week ago. So we don't expect this earnings season to disappoint overall. It probably won't be so positively surprising as the first quarter, but it should give more evidence that we are actually just in a soft patch at the moment and not necessarily heading for a double dip.
What does that mean for the markets? We're hearing Manis, they're saying second quarter numbers will probably drop by 28% for US banks.
Well, overall, I think markets have already rallied on the expectation that perhaps it isn't as bad as we thought a week or two weeks ago.
So some optimism in the markets
there is already quite a lot of optimism in the market, so I'm not seeing that much more upside at the moment in the markets. That is, unless we break through some of the technical levels which are currently forming almost a ceiling for the markets.
Enough to spark a rally?
There could always be a spark of a rally, particularly the European stress test for banks will have some potential to surprise, both on the up but also on the downside. We expect it to be more on the upside now that it's becoming a bit clearer that those stress tests are actually going to be fairly proper. I think there's some surprise going through the markets that there's not so much recapitalization planned at the moment compared to what we had a year ago in the US, but let's not forget, and we've just seen it, banks have made very large, substantial profits over the past year, and in Europe as well, which have helped to rebuild balance sheets.
It's interesting that you say that about the stress test, because many analysts and economists have really been voicing their concerns, investors as well, saying that if anything, well, the test might be fairly extensive, but nevertheless, they are essentially going to underestimate the level of loss that European banks will suffer in the event of a default or restructuring by a European country.
I probably disagree to a certain extent there. I think, yeah, the markets are very nervous and pessimistic at the moment, and everybody seems to want to find the negatives. But actually, I think the stress test, as what's been published so far, not much has been published, let's be fair, but it is looking fairly sensible. And what's also very sensible is that those banks where we're all expecting that they're going to come out weak, i.e. the Spanish Cajas and the German Landesbanken, there's already a plan of how to recapitalize them, i.e. go back to the bailout fund.
But exactly, I mean, there are concerns about about the ability of European countries to inject more cash into these banks at a time when they are struggling with their own mounting budget deficits.
But that's exactly the point where I think it's going to be positive for both the bond and the equity markets, because the stress tests overall will show that governments will not have to bail out the entire European banking sector, which was really the underlying concern about the sovereigns. The underlying concern, the sovereigns, the concerns, the debt crisis that we had wasn't just the ongoing debt. That's manageable.
So you think these tests could really restore market confidence in Europe's banks?
Not just in the banks. I think they have the potential to be quite a positive for the sovereigns as well.
Lothar Mentel, thank you so much for your thoughts, your analysis. Appreciate it.
Thank you.